The story has been told so many times. Elevated inflation has forced, continues to force central banks to tighten policy aggressively. We have seen that in the United States, in the euro area. We've also seen that in the United Kingdom. Now, interestingly, we are starting to see a very clear impact of that monetary tightening on business sentiment in manufacturing. In the United States, the ISM manufacturing index has been declining quite significantly, also well below 50, which is a key metric. It shows contraction of manufacturing activity. In the European Union and in the euro area, the business climate in industry has also weakened. Now, interestingly, when we turn to services, the story is different. The ISM services index in the United States has hardly moved from the level where it was at in May last year. And in Europe as well, in the euro area, business sentiment in services has actually rebounded quite significantly in recent months. What is explaining this resilience of services faced with rising interest rates? The resilience of services shows up in many data points. You see it in activity, in employment, but also, and this is something that central banks will not like, in price developments, input prices, output prices, and also in wages. So what is explaining this resilience of the services sector? First of all, let's keep in mind that at the start of last year, the business climate in manufacturing and in services was pretty good in both sectors. So the difference that we observed since then is that the impact of monetary tightening has made itself far more felt in manufacturing than in services. Now, one reason because why services have been so resilient is that this is an activity that is far more diversified. So you have parts of services that are more cyclically sensitive, that are more related to what is happening in manufacturing, but others like tourism and leisure, for instance, have little to do with what is happening in the manufacturing sector, obviously speaking. Another reason is that a lot of activities and services are using less debt, are using less leverage than is the case in manufacturing. So the quote-unquote absence of gearing, I would say, means that the sensitivity to higher interest rates is also going to be far smaller. Another element of difference between the two sectors, manufacturing versus services, is that within services, the labor intensity is far bigger. That implies that when you have labor market bottlenecks because of strong demand for services, it means that you have upward pressure on wages, but because wages represent a big component of the entire cost base, it will be reflected in service price inflation, which is then going to have a knock-on effect for inflation in general. You could actually use the metaphor of a train. When a train has been cruising at a good speed, it will take a lot of time until it slows down sufficiently, and the services train takes far more time to slow down significantly than would be the case with the manufacturing train. The resilience of services creates mixed feelings. On the one hand, it is welcomed. It means resilient services is underpinning GDP, is underpinning economic activity. On the other hand, it is making the task of central banks more difficult. Disinflation is slower, it means more rate hikes. It also requires more patience for central banks to see the effect of their rate increases on the economy overall. The key question is, will this divergence between manufacturing and services last? Already today we observe that the services subsectors that are more correlated with industrial activity, that are more correlated with what's happening in manufacturing, already are weaker than the other sectors that are less correlated. You see that last point, for instance, with respect to tourism and hotels, not correlated with manufacturing, and are actually very dynamic. So what you can expect is that anything which is closely correlated with manufacturing will suffer as manufacturing is going into an even weaker environment due to the higher interest rates. And then the other sectors that are less correlated with manufacturing, they actually, will very much be driven by what is happening in the labor market. We can indeed expect when the labor market is weakening, when the unemployment rate is starting to rise, that it will cool down the sentiment in certain sectors. Think of tourism, think of leisure, think of hotels, etc. So that means that, yes, the resilience, it should be welcome today. Central banks may not really like it, but in the medium run, we still have to expect that the rate hikes will also create weakening of the business climate in services. Thank you for having watched Eco TV Week this week, and I invite you to join us again next week. Bye-bye.